What's up, Weekend Warriors? Jacob Keen here, research analyst at Henssler Financial, trying to show you how to put some bang in your buck on another edition of Casual Finance Friday.
Get down, baby!
Halfway across the world, in the year of the pig, I'll walk you through why China is the most important risk to global markets. You may be aware of recent US-China trade tensions, with the US administration raising tariffs on $200 billion in Chinese goods from 10% to 25%. This will certainly have an effect on global growth, but may more importantly expose distortions in the Chinese economy. In 2010, China's GDP was 6.1 trillion, and in 2017, this reached 12.2 trillion, a doubling of GDP in 7 years. However, it took debt growth of over 23 trillion to accomplish this goal. China's debt to GDP currently stands at over 300%, by far the highest of any country globally. This level of debt may prove a problem. The hope is they can grow their way out of it and engineer a soft landing. However, there are some immediate threats to this plan, and it all starts with the currency, the yuan. In China, they manage the currency to a loose peg to the dollar in order to minimize volatility. They want their global trade pricing to be stable, and a large amount of banking and global trade happens in the dollar. They also do not want to risk their citizens experiencing rapid inflation and lose political stability, or have citizens moving money out of China. They have instituted capital controls and limits on the amount of money citizens can withdraw in a foreign currency. In simple terms, currencies get their relative values from supply and demand. The supply is affected by money creation through debt and imports. Demand is set by what rates are paid on savings, interest rates, the attractiveness of investments, and exports. Central banks can control the currency through rates or reserves, other countries' money, and net trade also has an outside effect. Net trade with China is in decline. Foreign investors are also starting to get antsy. This may put pressure on the yuan to devalue, and this would introduce currency instability and force China to make a decision. In early 2017, the dollar yuan got to almost 7. This is an exchange rate of 7 yuan for $1. This is the lowest value of the yuan since 2008. It's a psychological level, and if the yuan per dollar goes above 7, then everyone might need to worry. In fact, governors at the People's Bank of China have outright called this level the line in the sand. The yuan is nearing that level. Let's see what happens if it breaks. In scenario 1, China dumps treasuries. Not only would this infuriate Washington, but this would be a huge show of weakness and risk exacerbating any run on the currency. The only thing backstopping the entire financial system when the majority of Chinese banks are state-owned are the central bank assets. In scenario 2, they raise interest rates. Right now, Chinese growth data looks as bad as it has in over a decade. The last thing you do when growth is sputtering is raise interest rates, making it more expensive for businesses to borrow. Finally, in scenario 3, China simply lets the currency devalue. China has over $3 trillion in dollar-denominated loans, and if the currency devalues, these interest payments on businesses become more expensive again, and it also risks capital flight from Chinese citizens. A Chinese currency shock would risk global economic growth. China's contribution to global GDP growth is 33%, and if you include the rest of Asia, that number becomes 63%. China is highly indebted, and the only way they keep from collapsing under this debt is through a stable currency. We have already seen rising non-performing loans and large corporate bankruptcies in recent years in China. If this debt begins to unwind in an explosive manner, then it's going to affect everyone from Apple to Alibaba. Our hope is that trade war concessions come, the US and China come to a deal, and the currency stays stable. I just wanted to share the biggest risk to the global growth story and why. I'm not saying dollar yuan gets to 7.5 or 8 and you fill up your bug out bunker with dried food. I am saying global growth will struggle if this does happen, and all the more reason to focus on investing for the long term in high quality, attractively valued equities. Or in other words, don't be a hog in the year of the pig. This has been Jacob Keen, research analyst at Henssler Financial, signing off on a moderately casual Finance Friday. Thank you.